Welcome back to We Are Cosmic. If you are new here, this is the channel where we don't chase hype. We study money, systems, and long-term wealth, especially in crypto. My goal is simple: help regular people understand how the financial world really works, the same way banks, institutions, and wealthy families think about assets. Now let me ask you a serious question. What if one decision you make today could change not just your life, but your children's lives, your grandchildren's lives, and even generations after that? Not overnight, not magically, but through patience, discipline, and understanding how value actually moves in the world. There's a post circulating from Rob Cunningham that really made me stop and think. The idea is simple but powerful. 10,000 XRP could change a family's future forever, not because of hype or price predictions alone, but because of mindset, because of how assets are treated over time. And before you roll your eyes and say, "Here we go again with price talk," slow down. This is not about getting rich quick. This is about thinking like a banker instead of a consumer. Here is the model. Year 0. A family founder makes a decision. That decision is to accumulate 10,000 XRP. The price today doesn't even matter. The most important thing is the choice itself. From this moment forward, the family follows one simple rule. We never sell the asset. We hold it. We stake it. We borrow against it. We build with it. And most importantly, we teach the next generation how it works. This is where most people lose the plot. The average person thinks wealth comes from selling assets. Wealthy families know that real power comes from owning assets and letting time do the heavy lifting. Now imagine 10 years pass. Let's say XRP reaches $1,000. You are not selling anything. On paper, your family now controls $10 million. You didn't trade, you didn't gamble, you didn't panic. You just waited. Here's where it gets really interesting. In a mature XRP ledger world, conservative institutional staking or lending could easily produce around 4% annually. That's not aggressive, that's conservative in financial terms. 4% of $10 million is $400,000 per year. That's over $33,000 every single month while still owning every XRP. Ask yourself honestly, what would that kind of monthly income change in your life? Your stress level, your choices, and here's what wealthy families do next. They don't sell, they borrow. Instead of selling XRP, the family borrows just 10% of the asset's value, $1 million at low interest, using XRP as collateral. That money can be used to buy rental real estate, start a business, fund education, invest in other assets, or help your children build their own future. You are using the asset without destroying it. This is how real wealth works. Now combine both strategies. You've got $400,000 in annual yield plus access to low-cost capital, all without selling a single token. The family is no longer living paycheck to paycheck. They are living a banker lifestyle, not a consumer lifestyle. This is only year 10. And here's the mindset shift I want you to really hear. This isn't about cars, clothes, or showing off. It's about ending the cycle of financial struggle, paying for education without debt, owning property instead of renting forever, funding causes bigger than yourself, building something that lasts long after you're gone. This is what generational thinking looks like. Now let's fast forward, because this story is not about 10 months or even 10 years. It's about what happens when time and discipline are allowed to compound without interruption. Year 30. The family never sold their XRP. They didn't panic in bear markets. They didn't chase shiny new narratives. They understood one rule. Assets reward patience. Now imagine XRP reaches $5,000. That original 10,000 XRP is now worth $50 million. Pause for a second. This is not about fantasy numbers. This is about scale. When assets reach institutional scale, behavior changes. At $50 million, even conservative strategies create life-changing cash flow. A 4% yield alone produces $2 million per year, or about $166,000 per month, without selling a single XRP. At this level, lifestyle decisions stop being emotional. What does your housing cost really matter when your passive income covers it many times over? What does inflation feel like when your yield rises faster than expenses? This is why wealthy families don't obsess over prices of groceries or fuel. Not because they're careless, but because their cash flows absorb shocks. And this is where something deeper happens. Wealth stops being about survival and starts being about purpose. Education is funded. Properties are purchased strategically. Businesses are built not for quick profit, but for legacy. Debt is no longer a trap, it becomes a tool. Charities, foundations, missions, and community projects can be supported without stress. Most families never reach this point because they sell too early or never build assets in the first place. Now let's introduce a second powerful concept: borrowing at scale without selling. Instead of borrowing 10%, imagine borrowing 20% of the asset's value over long terms at low interest. A $10 million collateralized credit line on a $50 million asset changes everything. You're not liquidating, you're unlocking. That capital can buy commercial real estate, farmland, infrastructure projects, or even create family-owned financial entities. At this stage, the family is no longer participating in the system. They are interacting with it on equal footing. This naturally leads to the family bank model. The family sets up a trust or holding structure. Yield flows in annually. Credit lines are managed responsibly. Education is built into the system so future generations understand why assets are held, not just that they exist. The family doesn't rely on banks. They operate like one. This becomes a 100-year engine. And here's the most important part of this entire model: mindset transfer. Children and grandchildren don't just inherit money, they inherit knowledge. They learn how to live off yield instead of salary. They learn how to borrow smart instead of selling assets. They learn that inflation punishes cash but rewards ownership. They learn patience as a superpower. This is how families move from working class to stable, stable to prosperous, and prosperous to sovereign. And this is why the conversation around XRP matters so much. XRP is not designed like a meme coin. It is not a number go up toy. It is a utility asset built for movement of value across borders, institutions, and financial rails. It behaves more like commodity money, similar to gold, but digital, liquid, and programmable. The real power of XRP is not just price, it's structure. When you understand that, price volatility stops scaring you. Red candles stop triggering emotional reactions. Instead, you start asking better questions. Who is accumulating? Where is supply going? What is being built quietly while others are distracted? And that's exactly what we're seeing now. Institutional players don't think in weeks or months. They think in decades. And their behavior right now is sending a very clear signal. Even if most people are not ready to hear it yet. Most people stare at price charts all day. Green candle, red candle, panic, excitement, repeat. But the real story in financial markets almost always happens under the surface, far away from social media noise. That's exactly what's happening right now with spot XRP ETFs. We've officially crossed $1 billion in assets under management in XRP-related exchange-traded products, and almost nobody is celebrating. Why? Because institutions don't create hype, they create positions. Every XRP that enters an ETF is taken out of the liquid market. That means it is locked inside regulated structures, custody systems, and long-term frameworks. It's not trading on exchanges. It's not being panic sold on red days. It is removed from circulation. This is called structural scarcity. Over 400 million XRP is already locked inside ETF structures. Daily trading through these products sits around $25–30 million per day, and this is happening with zero marketing and zero retail FOMO. That should get your attention. Think about who is behind this. Firms like Bitwise and Franklin Templeton are involved. These are not fast money players. These are some of the most conservative and methodical asset managers in the world. They do not move early unless they understand the long-term game, and the game here is simple: steady inflows, supply compression, reduced volatility, price discovery driven by demand, not emotion. Based on recent inflow data, ETFs have been absorbing roughly 6 to 20 million XRP per day, depending on market conditions. At current prices, that doesn't feel dramatic. But zoom out. If that pace continues for just 15 to 20 trading days, another 100 to 300 million XRP could be locked away. And if this persists for several months, something important happens. OTC desks dry up. OTC desks are where large buyers go when they don't want to move the market. When those desks run thin, institutions are forced to compete in open markets. That's when price mechanics change quickly. This is why short-term price frustration doesn't bother professionals. Institutions actually prefer slow, boring price action while they accumulate. Volatility comes later, after positioning is complete. What makes this even more interesting is that ETFs don't care about sentiment. They don't read Twitter. They don't panic on red days. They accumulate automatically based on allocation and demand. That creates a regulatory pipeline that quietly absorbs supply every single day. This is how legacy financial systems convert speculative assets into structured financial instruments. XRP isn't being treated like a toy, it's being treated like infrastructure. And when infrastructure assets are accumulated quietly, the price often looks wrong for a long time until suddenly it doesn't. Now add one more layer. Volatility tends to decrease when ETFs grow. We've seen this with other assets. As institutional ownership increases, wild swings soften. That doesn't kill upside. It supports sustainable expansion. This brings us to a critical question. If retail investors are complaining but institutions are accumulating, who is most likely wrong? Because the real question is not why hasn't XRP moved yet? The real question is what do these firms see that most people are ignoring? And that takes us straight into real-world utility and adoption. One of the biggest mistakes people make in crypto is confusing speculation with utility. Most tokens live and die by narratives. XRP is different because it was never designed to be a hype asset. It was designed to move value inside real financial systems. That distinction matters more now than ever. When you listen to experienced market participants talk about XRP, one theme keeps coming up. Adoption is already happening, even if most people don't see it yet. Ripple has spent years doing the unglamorous work, building relationships with banks, payment providers, and financial institutions around the world. This is not startup behavior. This is infrastructure behavior. Ripple's focus has always been the same. Build the rails first, then scale usage once regulation allows it fully. And regulation is the missing piece most people underestimate. Here's the reality. All global money flows through the United States at some point. Whether it's trade settlement, banking liquidity, or currency conversion, the U.S. remains the center of gravity. That's why regulatory clarity in the U.S. matters more than anywhere else. Once banks are given a clear, well-defined framework to use digital assets, behavior changes fast. Institutions don't move slowly once rules are clear. They move decisively. This is where legislation like regulatory clarity acts become critical. When that switch flips, usage doesn't grow linearly. It grows exponentially. XRP Ledger is already being prepared behind the scenes. Stablecoins, settlement tools, tokenization frameworks, the plumbing is getting installed. XRP sits at the center as a bridge asset, designed to transfer value efficiently between systems, currencies, and networks. Now let's address something important and keep expectations realistic. XRP is not built to behave like Bitcoin or gold. It's not designed to sit still and do nothing. It's designed to circulate. It moves through the economy. It facilitates transactions. That naturally raises questions like, if it's moving, how does price go up? The answer is utilization. As adoption increases, demand for liquidity increases. As institutions rely on XRP for settlement, they need reliable access at scale. That creates underlying continuous demand, not speculative spikes, but structural demand. And when supply is already being locked inside ETFs and institutional custody, that demand has a powerful effect. What you tend to see first is price stabilization. Wild swings calm down, the asset becomes more trusted. Then, as usage accelerates, price begins to grind higher, supported by real flow instead of emotion. That's exactly how mature financial assets behave. Another point that often gets misunderstood is the role of stablecoins like RLUSD. While much of its liquidity today may sit on other chains, the important thing is direction of travel. As more infrastructure is built on the XRP ledger, liquidity follows. Developers go where efficiency is highest. Institutions go where settlement is cheapest and fastest. Nothing moves all at once. It migrates over time. This is why long-term investors don't need everything to be perfect today. They need to see trajectory. And the trajectory here is clear. Regulatory clarity, ETF accumulation, increasing institutional confidence, and expanding real-world use cases. These are not hype signals. These are structural signals. That's also why many professionals expect volatility to compress before expansion. Calm markets often frustrate retail investors right before significant moves occur. It's the quiet before the system fully wakes up. When you want to understand where an asset is headed, you don't listen to influencers, headlines, or emotional debates. You watch where professional money is actually flowing. And right now, the data around XRP is quietly telling a very interesting story. A recent report from WisdomTree highlights something that should not be ignored. XRP is currently the only major cryptocurrency that has seen sustained institutional inflows across every region and every product type, even during periods when most of the market was experiencing heavy selling. Let that sink in. While Bitcoin and Ethereum products were seeing outflows in multiple regions, institutional investors continued to allocate fresh capital into XRP consistently. This wasn't a one-week anomaly. This happened throughout the year. In total, institutions added around $549 million into XRP-focused products this year. That number is larger than what went into Ether products and significantly more than most large altcoins. Outside the United States alone, investors added roughly $252 million into XRP products, almost the same amount that flowed into Bitcoin products, despite Bitcoin markets being more than 25 times larger. That comparison is critical. Dollar for dollar, institutions are allocating far more aggressively into XRP than they are into Bitcoin in many global markets. That tells us this isn't about brand recognition, it's about utility, future positioning, and structural opportunity. In the United States, where XRP investment vehicles are still relatively new, synthetic XRP products attracted over $240 million this year. By contrast, comparable products for other major altcoins pulled in only a fraction of that amount. Even more telling is what happened when markets turned negative. In one recent month, Bitcoin and Ethereum products together lost more than $6 billion globally. XRP products, on the other hand, continued to receive inflows. That means when institutions had to choose where to park capital during uncertainty, they chose XRP. This is rare behavior. Institutions are not emotional. They don't fall in love with assets. They allocate based on risk-adjusted opportunity. If they continue to buy an asset while selling others, it means they see asymmetric upside with controlled downside. This pattern lines up perfectly with what we discussed earlier: ETF accumulation, supply compression, and regulatory positioning. The money flow confirms the thesis. Another key insight many people miss is this: institutions often position before clarity, not after. By the time regulation becomes obvious to the public, the largest allocations are already made. Retail investors usually arrive during the excitement phase. Institutions arrive during the quiet phase. That is exactly where we are now. You can see it in the charts. Price looks slow, momentum appears stalled, sentiment is mixed, and yet capital keeps flowing in through structured products. That contradiction is not accidental, it's the setup. This is why experienced investors stop asking, why hasn't the price moved? They start asking, why is so much smart money moving while price stays flat? The answer is simple: accumulation. XRP is not being chased, it's being absorbed, and absorption always precedes expansion. The most interesting moments in markets are when public attention is low, but professional confidence is high. Historically, those moments have offered the best risk-to-reward opportunities. That doesn't mean prices go straight up tomorrow. It means the foundation is being built. This was never about a single price target. It was never about hype, fear, or daily candles. This entire conversation has been about how systems change and how those who understand the system early position themselves accordingly. The generational model we talked about at the beginning only works with one core principle: ownership. Families that rise long-term don't sell productive assets. They build around them. They borrow wisely, they live off yield, they teach patience. XRP, in this framework, is not a lottery ticket. It's a financial rail asset positioned inside a global transition. At the same time, institutions are telling the same story, not with words, but with capital. ETFs quietly locking supply, asset managers allocating without marketing or hype, global inflows continuing even when the broader market pulls back. This is not emotional money. This is strategic money. Then you layer in real-world utility. XRP is designed to move through the financial system, not sit on the sidelines. As adoption increases, liquidity demand increases. As liquidity demand increases, access to supply becomes critical. And when supply is already being absorbed by ETFs and long-term holders, price has no choice but to adjust over time. That adjustment doesn't happen in a straight line. First comes frustration, then disbelief, then suddenly normalization. Most people never make it past the frustration stage. This is where mindset really separates outcomes. Consumers chase results. Bankers build engines. Consumers sell assets to buy liabilities. Bankers hold assets and let time work for them. One path feels exciting in the short term. The other changes family destiny. None of this requires perfection. You don't need perfect timing. You don't need perfect information. You don't need to predict exact numbers. What you do need is discipline. The uncomfortable truth is that wealth is built slowly, then revealed suddenly. The market does not reward impatience. It transfers value from the emotional to the prepared. As we move toward 2026 and beyond, the question won't be, did XRP work? The question will be, who held long enough to benefit from the shift? Regulation will mature. institutions will expand usage, infrastructure will become visible to the public, and by the time everyone agrees what XRP is, positioning will already be done. This is why I keep saying, think like a system, not a speculator. If you believe the world is moving toward faster settlement, tokenized assets, and regulated digital finance, then assets that sit at the center of that transition matter. If you believe institutions will dominate future liquidity flows, then you pay attention to where they allocate quietly, not loudly. And if you care about freedom, options, and generational stability, then you focus on assets before lifestyle. That's how families break cycles. That's how financial stress ends for good. That's how opportunity is created instead of chased. I'm personally still focused on accumulation and strategy, not prediction. I don't need this to happen tomorrow. I need it to happen correctly. And everything we're seeing, from ETFs to institutional flow to regulatory preparation, tells me this story is still early. If you got value from this breakdown, take a second to support the channel, like the video, share it with someone who needs to hear a different perspective, and leave a comment. I read them all. This channel grows through conversation, not hype. Thank you for being part of We Are Cosmic. We're not here for noise, we're here for understanding.